Two SaaS companies reported earnings after the market closed yesterday, but the divergence in what the stocks did tells a huge story about what's happening in the age of agentic artificial intelligence or agentic AI. Those two companies were Snowflake and Salesforce. And as you can see, Snowflake saw its stock boom, going up nearly 40% after reporting, whereas the results for Salesforce were much more muted. So what's going on? Well, let's spend the next couple of minutes trying to figure this out and what it might mean for the future of software as a service stocks. At the time of this recording, I do not own shares of either of these companies, and I want to give a shout out to Fiscal AI for sponsoring today's video. More from them in a minute. Let's start out with Snowflake, a roughly $80 billion company that reported its first quarter earnings. And when we look at them, revenue grew 33% and beat analyst estimates, management guides for product revenue growth, and they handily beat those estimates as well. Now, earnings per share and profit is on a non-GAAP basis because you'll see in a minute this company has no problem diluting shareholders. That said, earnings per share came in ahead of analyst estimates. Management guided for a 9% non-GAAP operating margin, came in way ahead of that at almost 12%. Now, all of these margins are presented on a non-GAAP basis. Gross margins shrank ever so slightly, which isn't surprising because gross margins for software traditionally were very high. But when you have to pay for the compute and the tokens for AI, that pulls them down. Again, this wasn't a huge deal. The non-GAAP operating margins expanded meaningfully, and so did the company's net margins. Free cash flow grew, net income grew. The balance sheet is in pretty good shape. Not pristine, but pretty good. All right. Now, on a GAAP basis, which importantly includes stock-based compensation, let's go down the income statement. So revenue is up 33%. The cost of that revenue is up about the same. Again, there's different forces at play here with AI costing more than traditional software, which is why gross profit grew at exactly the same amount. The real kicker came here. Operating expenses were only up 10%. So when you can grow revenue 33% and your operating expenses are only up 10%, that's great. That's why their operating loss, remember, this company hands out stock-based compensation like it is candy. It's still losing money, but those losses narrow by about 27%, and their net losses narrow by about 31%. But you gotta know that if you buy shares of this company, you will be diluted. Fully diluted shares outstanding increased by almost 4% from the same time last year. But what else happened during the quarter? Well, for that, we're going to go to Fiscal AI. Look, if you're an individual investor and you want to get better as an individual investor, then you need to use Fiscal AI. I use it every day, and if you want to use it, simply click the top link in the show notes below. So I've gone over, and the first thing that I want to highlight here is that we are seeing very clearly here that Snowflake is re-accelerating their revenue growth rates. Now, look, a year ago, 26% growth, there's nothing wrong with that, but it is accelerated to 33% growth in the most recent quarter. It's worth pointing out what management had to say about that during the conference call. Its Cortex code, which it calls Coco, is a new product that was only released during the first quarter. And yet they spent most of the conference call talking about this and crediting this brand new product with the reason for their reacceleration. That's a big deal because what we see here is a company saying, look, we introduced a new tool, an AI-based, usage-based, which Snowflake is. Snowflake is a usage-based company. You don't pay based on the number of people that might be using your product or service. It's based on how much they use it. That's really important when we talk about the differences between Snowflake and Salesforce in a minute. But they said that they saw huge demand for this new product that they just launched. So revenue growth reaccelerating is very, very good news. If we look at the total number of customers that Snowflake has, they're now sitting at almost 14 million. And again, there's nothing wrong with 18% growth in customers, which is where they were a year ago, but that growth rate is reaccelerating. re-accelerating growth rates for almost any financial metric is like magic because it pushes the future value of those cash flows higher and higher and higher. If we look at the total number of customers that are paying Snowflake at least $1 million, look at it flatlined at about 25%. But look, if you can stay above 25% growth in the number of customers paying you $1 million per year in annual recurring revenue, that's amazing. And they've been able to grow it at that rate now for 1, 2, 3, 4, 5, 6, 7, 8, 9 quarters in a row. Very good news for the company, and the shareholders should appreciate that as well. Finally, we have remaining performance obligations. Now, this is really important because what remaining performance obligations means is that this is money that customers have already paid Snowflake. Okay, they've already paid Snowflake, but Snowflake doesn't get to count that as revenue until they've used up the compute that they've purchased. And what we see here is the most important thing here is there was a slight downtick in the growth from last year, but what you have to know is that the previous quarter includes the beginning of the year, and that's oftentimes when people will more or less re-up what they've got that they can spend, if you will. So this is not unusual to see a slight step down. You saw the same sequential step down right here last year, the year before as well. The important thing here is that revenue was growing at 33%, but remaining performance obligations was growing at 38%. When RPO is growing faster than overall revenue, that's a great sign. Now, usually management lets us know how much of that is going to be recognized within the next year. That was not included yet, so we don't have those details yet. The final thing that I would like to point out is the company's net revenue retention rate. Now, what this means is if you take all the brand new customers that Snowflake has, and we know that they've got a bunch, and you just throw them out, and you just take the same cohort of customers from one year to the next, you say, how much did they spend? And what we see here, 126%, what that means is they not only, on average, held on to all those customers, but they got those customers to spend 26% more than they did in the prior year. And that is enormously important as well. Look, the AI products, the management clearly said on the conference call, they do have lower gross margins. But if you can make up for that with more revenue growth, that's not a serious problem. And the company is also continuing to build out its network effect in that 42% of Snowflake customers have a stable edge. And what that means is their data is for sale and others can buy it and use it. Financial institutions need this for a lot of what they do. But you can't do it unless you're on Snowflake's platform. And that is a network effect. Now, when we move to guidance, I think you're going to see why the stock is up so much. Management only guides for product revenue growth, but they are now guiding for 30% product revenue growth in the next quarter. Analysts are only expecting overall revenue to grow 25%. So we are seeing a significant beat and raise here. And that is really important because it says that, look, we just released this new product, Cocoa, and people are using it like crazy. And it's usage-based, which just means the more they use it, the more that we get paid. They also, said that they expect non-GAAP operating margins to come in at 12.5%, which is an increase from the same time last year as well. So all in all, what we see here is a usage-based software company saying, not only is AI accelerating the usage of what we have, but this new product, Cocoa, is accelerating that growth. So it's not a huge surprise to see the market saying that they really love it. So what should we watch moving forward? Well, number one, listen in for commentary on the growth of Cocoa, which again is Cortex code. Number two, keep an eye on those gross margins. They may come down a little bit, but if the revenue growth more than makes up for that, that's not that big of a deal, which is why number three is keeping an eye on revenue guidance. And number four, you got to know you're going to be diluted if you invest with this company, so keep your eye on that as well. Look, I think that the moat is growing around the company. If they've got a product and they have this place where that data that cannot be replicated sits, that's a powerful place to be in this value chain. So what do we think of Snowflake now, given the company's 30 to 40% jump today in terms of valuation? Well, there's a couple different things that we could look at. We could look at the company's forward price to sales ratio. Currently, it's trading at about 9.5 times sales. Now, that is very high, but it is worth noting that it's about 33-40% lower than their long-term average. But let's say price to sales isn't what you like watching. You want to look at something else like their forward, I don't know, PE ratio. Let's pull this forward just a little bit. And what we see is they're trading at about 85 times forward earnings. Look, that is expensive. There is no denying that. That said, it is below the long-term average. And if we look at their forward over the next 12 months price to free cash flow, this is where it gets more reasonable. We're talking about 40 times forward free cash flow, which isn't bad for a company that's growing at 30% plus per year, and it's below its long-term average. But what I think is the most useful here is to do a reverse discounted cash flow analysis. So what we're going to do for this is we're going to go over here, we're going to put in the ticker SNOW. Now, I believe that Snowflake, if we want to optimize their free cash flow margins, we should optimize them at about 30%. So if we gave them a 30% free cash flow margin today, that would give them $1.5 billion in free cash flow. Give them a 3% terminal growth rate, a 10% discount rate, and now we have to say, well, how fast does Snowflake need to grow to justify this stock price? And we can bring this down to about, let's say 22, 21, so they need to grow about 21% moving forward per year for 10 years to be worth this. But wait, we actually need to bump this up a little bit because we know that Snowflake is a serial diluter. So we need to bump that up, I would say, at least 2 percentage points. So here's our bogey. Snowflake has to hit those 30% free cash flow margins and grow revenue by 23% per year over the next 10 years to justify this stock price. Well, what do we think about that? Could they grow 23% per year over the next 10 years? Well, what we can do here on Fiscal AI is pull this forward and say, well, what are analysts expecting? They're expecting 27% growth for this year. I wouldn't be surprised to see that revised upwards to 30% plus with the traction and the inflection point that Snowflake has been showing. So the rest of these, I also wouldn't be surprised to see go upwards. That being said, if you have 3 years of 30% revenue growth, you still got to keep up the revenue growth to hit that 23% bogey in years 4 through 10. That is not a small thing. At the same time, we can say, well, how have analysts done with these estimates in the past? And what we can see is that while they were overestimating coming out of the pandemic and just before the advent of ChatGPT, what we can see here is that over the last couple of years, they have been underestimating revenue growth and revising those upwards. So the real question here in terms of the valuation of Snowflake is how durable do you believe that revenue growth could be? If you believe from years 4 through 7, which would really be 2030 to say 2036, if you believe that they can have revenue growth of over 20%, well then today's stock price makes all the sense in the world. But if you don't, then it might be a little bit expensive. So that's what was going on with Snowflake. Remember, Snowflake, usage-based, inflection point, showing that AI is really powering the company forward. Because the next stock we're going to talk about is a different story, and that is Salesforce. But before we get to Salesforce, I want to let you know that if you enjoy breakdowns like this, you are a prime candidate for my investing program called Stock Investing Men. And the way that this program works is that it comes in 3 parts. The first part is 1 hour of live weekly training sessions, Thursday at noon Eastern, that are recorded if you can't make it, where I'm teaching you one nugget to become a better investor. And we stack 50 plus nuggets every year on top of each other. 2, you get full real-time access to my real-life stock portfolio, and I've been tracking those results for over 10 years. Now, you might notice that green line, those are my results. They're well ahead of the S&P 500. You might also notice that this year we've dipped below the NASDAQ composite. You better believe that I'm doing everything I can to make sure that over the long run, I get back above that. And number 3 is you get 24/7 access to a private online investing community. Now, if this interests you, the second link below will get you 15% off an annual membership. 10% off an annual membership to Stock Investing Mentor. So let's talk about Salesforce, which is a much bigger company. It's about a $140 billion company. Revenue growth was ahead of estimates, but much slower. Remember, Snowflake was 33% revenue growth. Salesforce is at 13% revenue growth. Earnings per share came in at $3.88, which was well ahead of both analyst estimates and management's own guidance. Let's look at margins. Margins took a step down, but this is a very, very small step down. It is not something that I would worry too much about. And operating and net margins expanded meaningfully. Free cash flow grew, but not by a ton. Net income grew more substantially, but look at this. The balance sheet is completely upside down now. And it was not like this just a year ago. And you might be wondering, what's going on there? I'll explain what's going on there in just a minute because it's important to know if you're investing in this. First, we're going to go down the income statement just like we did with Snowflake. So, Salesforce is growing 13%. Now, on the call, they did say that Agentforce is now bringing in more than $1 billion in a revenue run rate, which is great. But here's the problem. Agentforce, which is more usage-based, remember that was the key word when we talked about Snowflake, usage-based, is still less than 10% of Salesforce's revenue. The rest of the traditional revenue is seat-based. And in an age when a single person using AI can become 10x more productive than the number of seats that you might use, the number of employees that you might give access to certain data and tools is going to shrink. And that creates a serious problem for companies that are traditionally seat-based. And that is what Salesforce is. That is one of the big reasons why Salesforce is not having the stock the same reaction that Snowflake did. So 13% revenue growth. Same dynamics are at play. As these AI tools become more popular, they will create somewhat of a drag on gross profit, which is why the cost of revenues grew just as much as the revenue, which means that gross profit, their gross margins didn't really expand. They were about the same. Now, it is worth noting that operating expenses were only up 10%. So 10%, that's coded green because they're growing slower than revenue, which is why income from operations was able to grow 21% and net income was able to grow 37%. But look at this. Whoa! The number of shares outstanding was down 10.2%. 10.2% from the same time last year. How in the world did this happen? Well, it happened because the company took on a boatload of debt. You just saw that in the previous slides. And they had a $25 billion accelerated share repurchase program. In other words, management went to banks, took on debt, and immediately took that money and repurchased their own shares. Here's the way that this works out. If the company can show that it can survive, not just survive, but thrive and re-accelerate revenue meaningfully in the age of agentic AI, well, then those buybacks are going to be a bonanza for shareholders. But if they can't prove that, or if it takes a really long time to prove that, taking on all that debt is going to be a drag on the company, especially on its balance sheet. We don't know how that's all going to turn out. But again, let's turn to Fiscal AI to see what else was happening during the quarter. Now, I will point out that Salesforce is experiencing, this is revenue growth rate, the same type of re-acceleration in revenue growth as Snowflake showed, but on a much more muted basis, from 8% growth to 13% growth. All in all, not terrible. The other thing that's worth pointing out is overall remaining performance obligations. And this is where we run into a little bit of trouble again. Remember, we saw remaining performance obligations growing faster than revenue for Snowflake, and it was in the high 30s. When we talk about Salesforce, what we see is that remaining performance obligations only grew 11.5%. Here's why that's a problem. 11.5% is below the 13% that revenue grew. And in fact, I went back and created my own chart using some numbers to show what's going on with current remaining performance obligations. So that means like revenue that's expected to be recognized within the next 12 months. Now, some of these numbers, I did my best to create this quickly, but what we see is there's not quite the same type of reacceleration that we saw with other companies. So the bottom line here is that while management is touting that Agentforce is growing, and it is absolutely the right move to be focusing on Agentforce, while you have that growing, you've got their seat-based revenue coming down, and they specifically called out how Tableau is really dragging on things, and the growth is coming from Slack, 360, and Agentforce. And right now, the drag from some divisions and the boost from Agentforce and 360 and Slack, they're kind of canceling each other out. And that's why you're not seeing the same type of reaction with Salesforce as you did with Snowflake. Here's another reason. So management touted on their conference call a beat and raise. And indeed, they did raise the midpoint of full year guidance by $50 million, which means that it's basically expected to come in right where analysts were expecting. But here's the problem. They raised their guidance that they gave last quarter by $50 million. Here's the problem. They beat what they thought that they would do for this quarter by $83 million. So when you think about this, what they expect to get in quarters 2, 3, and 4 is actually about $33 million less. Now, of course, they could be sandbagging. They could beat those results. But when you don't raise your full year guidance by as much as or more than you just beat the guidance for, well, then you're actually lowering the guidance. And I think that Wall Street understands that math as well. So what I would watch moving forward if I were a Salesforce investor is I would watch gross margins. You want to see that those stay high. You want to look at the current RPO and the RPO growth. You want it to be faster than revenue. Number 3 is revenue. Keep an eye on guidance and listen in for comments on Agentforce. The moat is uncertain. The thesis is uncertain. Those should actually be coded yellow. I'm not 100% convinced, but this does have a compelling valuation. Here's what I mean. This is on a trailing basis. Right now, Salesforce is trading for 20 times trailing earnings. Just over the past couple of years, its average is 45. Fairly reasonable. What about if we look at their price to free cash flow? Right now, it's just trading at 10 times trailing free cash flow. That's very cheap. So you are being compensated for this uncertainty. But make no mistake, if they can't show that they can reaccelerate it, a great valuation will not save you as an investor. And some people might look at the overall shareholder yield that the company has, or you might look at this buyback yield. I mean, look at the buyback yield because of these buybacks is sitting at 25%. And you might say, this is a no-brainer. Well, you've got to keep in mind that the debt paydown yield, while the buyback yield is 25%, the debt paydown yield is negative 21% because they took on all of that debt to make this happen. So there's puts and takes there. Again, we can do the same thing that we did before and do a reverse discounted cash flow analysis. And if we do, and if in my mind I'm saying, well, for Salesforce, let's assume a 35% free cash flow margin. Maybe that's too generous. Maybe it's too conservative. I'm just telling you how I did this. At 35%, that's about $15 billion in trailing free cash flow. Let's lower this terminal growth rate to 2%, given that analysts are more bearish on this. And then we say, well, how fast does Salesforce need to grow to justify this price? And it certainly isn't 21% because those green and blue numbers are way off. Is it 10%? No. Is it 5%? No. Now, by now, we've got to lower this down to 1% terminal growth rate to really get a better idea for what analysts are expecting. And they are very clearly expecting like no growth, or importantly, a significant reduction in Salesforce's free cash flow margins. If you change this number, that changes things as well. So that's why we're seeing today what we're seeing. Snowflake has shown that its usage-based model and its new products that it's deploying are meaningfully re-accelerating revenue growth, and their remaining performance obligations are growing at a faster rate than revenue. Salesforce is having success with Agentforce. That's usage-based, but its legacy traditional revenue streams are still mostly seat-based. And even though Agentforce is growing, it's not enough to cancel that out. Now, you're compensated for that if you're an investor by a very attractive valuation, but you better believe that the company can execute and grow Agentforce faster than it loses revenue on its traditional seat-based platform for it to be worth it. So those are my thoughts on kind of this bifurcation within SaaS. Let me know what you thought of these companies' earnings in the comments section below. And don't forget to hit subscribe to keep up on these companies when they report next in 90 days. Until then, Brian out.